Good morning. Welcome to the Forex Pro Charts weekly analysis for the week of October 3rd through 8th, 2010. Every week for our subscribers we analyze 10 major currency pairs and we post a video on one of those pairs free. This week we're going to be looking at the Euro JPY pair. To begin our analysis, we look at the monthly time period chart. And we're looking at a couple of things here. First of all, we're looking to see where in our trading field price is currently located. Our trading field is defined by these two solid lines which indicate the monthly highs and the monthly lows. We are expecting price to reverse when it reaches the monthly highs and monthly lows, as well as at other various points in between as marked by our zones. We're looking on the monthly chart for a couple of things, as I said, to see where price is located in relation to the outer edges of the playing field, and also in relation to the monthly armpits and the weekly armpits, which define our monthly and weekly supply and demand zones. As we look at price on the EJ, we can see that price currently is about here, which is approximately midway between the resistance and support monthly and weekly zones, which means that we have plenty of room for price to move one way or the other, and we're able to take buys and sells. Day traders are pretty much always able to take buys and sells depending on the zone and the risk to reward, but swing traders would prefer to take trades in the direction of the trend. So we're going to look and see what the trend is. So we see that previously the trend, as defined by the 50 moving average, was up, but recently has switched and moved down. We see that the EMA switched probably when price hit this monthly high here and began to move down. We're also looking at the extended trend walls. We just kind of look at them in general on the monthly chart, in more detail on the weekend chart. So we do see that there are some extended trend walls, but they're not really in the area of the current price action. Next, we look at the weekly time frame. And what we're looking for here is more specifically where our trend walls are, what the chart pattern is, and where our zones are. Now we are currently, looks like on the weekly chart, we can see that we're currently at a zone, at a resistance zone. We have another large resistance zone above us. We have moved out of a support zone. So we are going to be anticipating that with price in this current zone, it could either reverse here and move back down to this support zone, or it may move and continue up. If it does continue up, we're going to see that we have some extended trend walls, the daily and the weekly trend walls that are intersecting right about here, depending on how long price takes to move and where these trend walls are when price gets up to this point. These may be a factor in how far up into this zone price moves. The other thing that we want to look for on the weekly chart is we want to look at the chart pattern. If you've gone back and you've studied our signature trade setup and how we define zones and our odds enhancers, you know that one of the primary criteria for a zone is the rally base drop pattern, or conversely, when we're talking about a support zone, the drop base rally pattern. Now we will always see this pattern at the origination of a zone on the daily chart, or we wouldn't mark the zone. That is one of the key criteria that makes a zone, is that particular chart pattern. So we will have that by the fact that the zone is marked. We had that on the daily chart. However, when we see that pattern also at the origination of the zone on the weekly chart, that strengthens the zone, and for swing traders especially is an additional indicator that price may make a long-term move at this area. So we can see that at this upper zone here, which is a couple of zones away, quite a distance in price before we get there, but when we do get to that zone, we see the rally base drop pattern. We also see in our current zone that there was a smaller rally base drop pattern, and of course at this support zone we also saw the drop base rally pattern. So this zone, and this zone have that support on the weekly chart, which makes it stronger. Looking at this zone, we see that really on the weekly chart this was part of an overall larger downtrend. So this zone we're not nuts about for long-term price movement for a couple of reasons, and we'll look at that in more detail on the daily chart. But on the weekly chart, it's because we do not see the rally base drop chart pattern. We're just strictly looking at it. It's part of a larger downtrend. So looking at the daily chart now, we're examining price in a little bit more detail. We see that price nicely bounced off of our 60-minute armpit actually 2 times, and actually went down the second time all the way to the 5-minute armpit as well, and then moved up to our daily zone. We're going to examine the bounces in a little bit more detail. We won't see this daily bounce, but you can see here price, when it hit the daily armpit, bounced down almost 100 pips. We're going to look at the price action up here in a little more detail on the hourly chart. What we're looking at here on the daily chart is as you can see, we have this zone which price may reverse and move. Actually, I think when we get to the hourly chart, we're going to see that price has actually spiked through this zone. Because price has spiked through this zone really is no longer good for trading. And should price reverse down and then come back up, this zone will be dead. Depending on how long it takes for that to happen, we may have marked a new zone somewhere in this area based on what price does. But since price has spiked through, and again we'll see that more clearly on the hourly chart, because price has spiked through, it's still close enough to the edge of the zone that we might see price reverse and continue down, but we also have a good chance of seeing price continue up to this zone. Now, as I said, this zone we're not crazy about for a long-term price reversal, and part of that was the chart pattern that we talked about earlier. Part of it also is the size of the zone and the relative risk to reward ratio. As you know, we're looking for a 3-to-1 risk to reward ratio in order to take trades. Now, that does not always, when you're talking about the bounce on the 60-minute armpit, we're looking at the risk to reward ratio for that particular risk. But when we're anticipating a longer term price movement, we're taking the whole zone into account. And you can see here we had a very large zone, and we do not have a risk to reward ratio of 3-to-1 because this is the area where price turned and moved back up to that zone. So at this time anyway, we do not have that 3-to-1 risk to reward ratio. If price moves up here, certainly would be suitable to trade the bounce off of the 60-minute armpit. That is a very reliable trade, and we like that here. And your risk is reasonable. However, you can see that this entire zone is about 400 pips. That risk is completely unreasonable, even if we see the intersecting trend walls at the daily armpit that sometimes in a smaller zone would make us might make us want to trade that daily armpit, which we don't usually do. But here, because of the size of the risk, we do not want to trade off of the daily armpit, and we do not look for a long-term price movement. So swing traders will not be wanting to trade this zone most likely, because the risk for the potential reward is just not there. There is too much risk, and there is too much chance that price will not reverse long-term and not justify the reward. The other thing that we want to take into account is this left behind target that is immediately behind the zone. If we're trading off the 60-minute or the 5-minute armpits, we will want to place our stop instead of placing it 10 pips beyond the end of the zone, because this left behind target indicated by this magenta line here is so close. We're going to want to place our stop 10 pips beyond that left behind target. Let's go ahead and take a look at the hourly chart, and it should be in a little bit more detail. And sure enough, on the hourly chart, we can see that price has moved and spiked up through the zone. We don't know yet whether price will continue up or whether it will move down. But you can see that for that reason, this zone will be dead, and when price takes a direction one way or the other, we may be adding an additional zone here if price moves down. Price movement off of the 60-minute armpit. You can see that price approached the 60-minute armpit a couple of times. Here we were about 10 pips away from the 60-minute armpit when price reversed, and some traders would have been, oh, it's so close, I wish I could take a trade. We recommend a 5-pip cushion before the 60-minute armpit for taking the trade, and in this case we would have been 10 pips away, so that would not have been suitable to take the trade. One thing that we don't want to do is chase trades. We want to follow our trading plan strictly and not chase trades and not alter our trading plan based on emotion and oh my gosh. There is always another currency to trade. There is always another armpit that's being approached, and there will be another trade down the road. And as we saw it, gosh, not all that far down the road, because here price came and was within, actually this was within 4 pips of our 60-minute armpit, and we would have entered this trade because we probably would have had, when price entered this zone, we probably would have placed an entry order. If we're following the signature trade strategy that we use, placed our entry order, so here that order would have triggered and we would have gained about 100 pips right here on this trade, which would have been probably the first and second portions of your trade. At that point you would have had only one portion left in, the third portion of your trade. Your stop would have been at break even. In this instance, your limit would have been down to the support zone below us, and that you would not have reached that limit. Price would have moved back up and triggered your stop when it got up here. Now you can see that price hit the 60-minute armpit again and did bounce basically 20 pips before moving up and out of the zone. Some traders wonder, well, can we place additional trades on the 60-minute armpit? Unless price moves significantly out of the zone, we do not recommend trading that revisit on the 60-minute armpit, because it's just too unreliable after it hits the first time, unless it has moved well out of the zone and that zone is still valid and price comes and revisits again. So while in this instance you would have made your 20 pips, you would have had to move your stop to break even immediately in order to avoid losing money if you had tried to trade this second revisit. So that is pretty much the analysis for the EJ for the week of October 3rd through 8th. For more information or to subscribe to our full analysis and charting services, we encourage you to go to www.forexprocharts.com. We have a variety of subscription plans, and as we said, we analyze 10 pairs each week of the major currencies and provide you information on trading zones and where you can take that 60-minute, that bounce off of the 60-minute armpit. We welcome you to our website, and we encourage you to come back next week for another free analysis. Thank you very much.